Morning, everybody. What a great day to be on New York Stock Exchange and to actually talk about Africa, which is a wonderful place for both for visiting and investing. We have a great panel here. I will introduce the panelists today. They're coming from three different countries. They're all publicly listed and traded companies. And all the way on my left is Philippe Espitalier-Noël. He's the CEO of Rogers & Company, a Mauritius-based, listed on the Mauritius Stock Exchange, $150 million market cap. Next to Philippe is Mr. Pradeep Pounrana, CEO of ARM. It's the Nairobi Stock Exchange listed company, $500 million of market capitalization, involved in cement plays of East African countries, Kenya and Tanzania. And right next to me is Mr. Neil Pretorius, CEO of DRD Gold, $1.3 billion market cap company listed on the JSE and involved in gold production. Each of these managers will actually have a few minutes to run you through opportunities that they see in their own sectors, their own companies, and their own countries. And I let Philippe start.
Thank you, Zoran. Good morning, everybody. I'll talk to you about three things maybe this morning. First, give you an introduction of my background. Secondly, I'll focus on Rogers as a company and what we're doing right now, what some of the opportunities are. And thirdly, focusing on a subsidiary called Ascensia, which is a property fund quoted on the market. My name is Philippe Espitalier-Noël. I'm seventh generation born in Mauritius. I've been there forever. I've been raised there. I've done my first degree in South Africa at the University of Natal. I then did a postgrad MBA at London Business School and worked in London for a few years. I joined the Rogers Group in 1997 after spending a few years overseas. And I wear the cap also of a controlling shareholder of our holding company called ENL. So when I moved into Rogers in 1997, ENL, which I share as a holding company, my three brothers and myself control. In those days, therefore, the ENL group only owned 15% of the effective stake of Rogers. And I've been instrumental in reshaping the group over the best part of the last 10 years, and bringing the ENL stake to a level of 60%. Rogers, the ENL group manages about $1.5 billion worth of assets, of which $500 million is actually within Rogers and managed by me and my team. Rogers was created in 1899, so we like to say it is a bit more than 100 years young. Very diversified group of companies which have come through in a very active manner, very present in the entrepreneurial dynamism of the country, post-independence and pre-independence. Did a lot of good work in terms of innovation. Rogers was the founder of the national airline Air Mauritius, and Rogers remains today the second largest shareholder of a national airline. Rogers started the tourism industry in Mauritius, creating the first hotel under the banner of New Mauritius Hotel, which has now become the largest hotel group in Mauritius, with assets in Seychelles also and in Morocco, overseas. Rogers did many other things, including developing the logistics part and the logistics hub of the business. We are the biggest logistics player on the island and probably the biggest loader of freight in the Indian Ocean. Rogers has done a number of other developments in the real estate business recently, launching a fairly big fund on the market in 2008. I'll talk about it a little later on, called Ascensia. We are also the second largest shareholder of the number one insurance company in Mauritius called the Swan Group of Companies, with a 28% effective stake. The insurance business runs general as well as life, asset management and stockbroking services. It manages about $1.2, $1.3 billion from the management angle of its asset management arm. We have a small IT business which is busy expanding and supporting the virtual part of what we do in our service lines. Over the last 10 years, Rogers has moved from a diversified conglomerate to become a service-focused based entity. Still very diversified, but we're no longer in any manufacturing nor any retailing side of the business. One of the biggest dimensions of change happened yet again in 2012, some 2 years ago, where we spun off the financial services arm of the business. And if one looks at the combined performance, the combined TRS of the entity that was spun off from Rogers, we've had in less than 2 years a TRS of some 55%. So we've done quite well. All shareholders have done very well. And it's allowed Rogers to also increase its focus on a narrower service line of business. The current asset base of Rogers under management is, as I said, $500 million. The net asset value of the business is $300 million, and we are trading at more than 40% discount with a market capitalization of $180 million. We've got a good growth story. The last financial year, we've had more than 20% growth in EBITDA, in PAT, and we're looking at a very strong growth possibility again in the next 2 years. We are building sufficient resources to actually grow the business further beyond Mauritius. We've established over the last 15 years some 52 small offices in 12 countries outside Mauritius, some on mainland Africa, Madagascar, Réunion on the islands, Mozambique, Kenya, South Africa, and we've got some businesses operating elsewhere for quite a long time now, namely in France, in Singapore, and in India. That's, if you want, the reach of a group. We are busy looking at opportunities for further development. The pipeline is fairly full. We have a very decentralized structure of management with specific boards and balance sheets to actually support each business line. So the arbitrage is actually being done at specific entity level. We run a modern governance structure with a non-family based independent chairperson who's also the head of corporate governance and audit. Even though we've got a strong family interest in the business, we prone modern, contemporary governance structures and philosophies, spend a lot on CSR, and have been actually acclaimed as, from a best practice point of view, by the United Nations regarding the work we've done in Mauritius to fight the progress of HIV, which is actually one of the few countries in the world where the rate of progress has actually decreased. So we've stopped our HIV program after 6 years, and we're now focusing, it's one of the reasons I'm here, on the actual degradation of our coastal environment, which is obviously with global warming and what we saw in the streets of New York yesterday, becoming an important dimension for Mauritius and small island countries. We will probably the market is looking at us as being illiquid. We have a small float with 2,000 shareholders, and we're busy looking at expanding that base and potentially, therefore, finding a way to narrow our discount to NAV, which we don't believe is fully justified, although the market is always right. We've got to do our work to make sure that is shifted. Just briefly on the Essentia story. Essentia was created in 2008, focusing on a yielding portfolio. It's the only vehicle which gives access to the property market in Mauritius. It's a full-fledged commercial property portfolio with 100,000 square meters, 100% rented, with inflation-indexed and turnover-indexed contracts which are fully in place. And we've had a TRS of about 110% since 2008, so about a bit more than 13% a year, approximately 4% dividend yield, and the 9% remaining on capital gains. The Essentia story keeps growing. It's a very efficient vehicle, given you don't have capital gains tax, you don't have tax on dividends, you don't have tax on transfer dues, and our parent company and ourselves, we're sitting on some 12,000 hectares of land base, of which we've dedicated 6% for development over the next 10 years. So we've got a big program of development, and the good thing about Mauritius is that if you transfer land across various subsidies, there's no transfer dues. So we've got a unique very efficient structure with rare real estate assets, which is going to actually boost the future of Essentia. And we're going to go to market to actually raise further capital next year. We're creating a development fund for Mauritius, a subsidiary fund of $100 million, and a fund of $200 million to actually develop on mainland Africa. We got a lot of calls from players who actually want to partner with us and share our expertise with them. So that's our story. I think two interesting ones regarding Rogers as an opportunity for investment and Essentia, both of which are looking to raise capital next year. Thanks.
Thank you, Philippe. Let's go to Mr. Paundrana, please.
Good morning. Thank you. My name is Pradeep Paurana. I'm the Managing Director and CEO of a company based in Kenya, a listed company on the Nairobi Stock Exchange. Our business is manufacturing of cement. The company is called ARM Cement. As a quick introduction, my father founded the cement company. In the last 10 years, we have grown the company to a market cap of $500 million. If you had invested in our company 10 years ago, I think you'd have got a 44 times return in that last 10 years. And the pace of growth is continuing. I studied at New York. I did my MBA at NYU Stern nearly 30 years ago, and I'm happy to be back here in New York. A lot of our institutional investors are based out of New York and London, increasingly from Singapore and Johannesburg, and other cities out of the United States as well. Kenya is in a unique position for growth, as is the rest of East Africa, of which Kenya is the biggest economy. Just to give you a background on the infrastructure developments and how this translates into growing demand for cement is what I'd like to spend a few minutes talking about. Cement consumption in East Africa as a whole at the moment is about 80 kilograms per person per year, 80 kg per capita. Now this compares to Egypt, for example, which is 550 kilograms per person per year, or South Africa, which is about 300 kilograms per person per year. If we take Mauritius, with a population of 1.2 million, Mauritius consumes 1 million tons of cement a year. And Kenya is just about 5 million tons, Tanzania 4 million tons, Uganda about 3 million tons. Altogether, the whole of East Africa, 120 million population, the cement consumption is just about 10 million tons. For the last 10 years, and this is the reason our company has been growing as rapidly and with the market cap as I described. For the last 10 years, the growth in the East African market, cement consumption has been at about 14% year on year. At this pace, cement consumption in the country, in the region, doubles every 6 or 7 years. Why is it growing so quickly? Historically, there's a very strong correlation in emerging market economies between the GDP growth rate and cement consumption. Cement consumption is generally 2.2 times that of the underlying GDP growth rate. And our economies have been growing at about 6% in spurts, about 7% sometime. And if you look at the region and you divide that into the countries, Tanzania is growing at a much larger, faster pace than Kenya. Kenya is about 5%, and Tanzania is about 7%. But the story going forward is even more exciting. Tanzania has discovered gas. It's already in production, and that is transforming the country's economy. Tanzania was already rich in mining industry, gold and diamonds. Going forward into the next few years, there's platinum and there's nickel and a few other minerals, including uranium, that are going to be in stream. Now that is important not only for cement consumption, but another subsidiary product that we manufacture, which is lime, which uses exactly the same raw material, limestone, and the lime is used extensively in the mining industry. Tanzania has coal, and in the next 10 years, going to be self-sufficient in its energy requirements. This means the capital formation in the country that is available to the government is huge. New ports are being built in Tanzania, new roads. In Kenya, the plan is much, much more ahead. Tullow Oil, you've probably heard, has discovered oil and is in the process of implementing a plan to extract the oil and export the oil out of the port of Lamu. Tullow Oil also has reserves and has just finalized the setting up of an oil refinery in Uganda. So both Uganda and Kenya have oil. In the next 5 years, by 2018, I think East Africa, and particularly Kenya, the largest, would be as big an oil exporter as Nigeria, 2 million barrels per day of oil. And we're looking at cash on stream from 2018, 2019. Kenya has already embarked on a huge expansion program. We built 10,000 kilometers of roads in the first 50 years after independence in 1963. The government has just embarked on the buildup of another 10,000 kilometers of road in the next 4 years. There's $5 billion to $7 billion of construction. We have already started constructing a new broad gauge railway. This is another $5 billion project. A new port is being built. New oil pipelines are being built. Now this all translates into huge requirement for cement in the infrastructure buildup. I'd like to talk about a little bit about our company now. We have 2.5 million ton capacity that we've built over the last 10 years using our own clinker. We've just commissioned our latest plant in northern Tanzania. It's a 1.2 million ton per day clinker plant. This is the single largest clinker line production south of Nigeria, largest in eastern southern Africa. We are building our cement plants at roughly $100 per ton of annual capacity, whereas most of our competitors in the market is building this at about $180 to $200 per ton. With a little bit of gearing up, our investors are seeing a huge return. For every $30 of equity, we're creating assets worth $300 million. And this is what is translating into our share price and our market capitalization. We've built a huge capacity with our own limestone reserves going forward for expansion, not only in Tanzania, but also in Kenya. We're now looking at putting up a new 2.5 million ton cement plant over the next 5 years. In terms of the regional expansion, and we've diversified our operations regionally, Tanzania, Kenya, and Rwanda. We are also looking going forward into Ethiopia, which is also rapidly growing, and other countries in the region. To conclude, Kenya is particularly at a moment where we have a huge explosion in our economy. The economy is ready to take off. We've had our challenges in the past. We've got a new constitution, which I believe is going to be a model and a blueprint for most African countries. We have a devolved system of government. The counties in the country have a share of the national revenue, which is being used to develop the counties at the county level, at the rural level, taking pressure away from urbanization, creating many new potential metros and metropolitan areas in the next 15 or 20 years. It's an exciting place to be, and our capital markets are becoming mature. From my own company point of view, we have raised instruments on the Nairobi Stock Exchange, listed bonds, equity-linked notes, convertible notes. We're looking for capital for the expansion as we go on. Every 5 years, we have our own investment plans, and we have a very dynamic exchange as well. So look forward to engaging with more of you on a one-to-one basis, and please do ask any questions when you have.
Thank you, Pradeep. Mr. Pretorius, please.
Thank you, Zoran. Thank you. Good morning, everybody, and for the opportunity to talk a little bit about our company, DRD Gold, and also our country, South Africa. DRD Gold's operations are situated in Johannesburg, which is the largest city in the world that is not next to a river. It became such a large city because of the magnificent gold deposits that were discovered there just more than a century ago. Now, what we do is a little bit different compared to what you'll find typically in the mining industry. We reclaim and reprocess all of the on-surface tailings that had been deposited and stored basically there for the last 100 odd years. Our company is listed on the Johannesburg Stock Exchange as well as here on the New York Stock Exchange. We are the oldest listed company in South Africa that is still in business. Because of our locality and because of the sheer size of our resource, with materials having been deposited there over the last century, we're sitting on just about 11 million ounces of resource. And what differentiates our company from many other companies in that region is that we've got both the infrastructure, the means, the skill set, and the space, plant capacity and deposition space to actually process most of the resource that we have under our control. We've developed over the last 30 odd years a mechanized process that is technology driven. We are on an ongoing basis looking at new and better ways of extracting gold from our tailings feed. Because of the diminishing quality of the resource over time, and also the fact that costs are always escalating, it is an industry where there are cost pressures that are sometimes different to what you would find just a normal CPI. It is important that we optimize every ton of material that actually enters our plant, and therefore we are very dedicated and very focused on continuous technology improvements in our process. We are fully unhedged, and as a consequence, we do offer shareholders and investors full exposure to the gold price. You would also find that our company, the share price in our company, because of liquidity and volatilities that's been established over time, does respond sharply to the gold price. And therefore, whilst our long-term vision is to establish a register of mostly smaller boutique-type institutional investors for the longer haul, the share does provide an opportunity to make a bit of money on either side of the gold price cycle. We're very fortunate in the sense that we have a built-in hedge insofar as our currency is concerned. So whilst the dollar may have increased in value and the gold price may have reduced in value over the last few months, our currency is also weakened against the gold price, and we pay our cost and our overhead in local currency. And as a consequence, the margin squeeze locally has not been as profound as you may have found in some of the other jurisdictions where the cost base is in US dollar. We've paid dividends now without interruption for the last 7 years. We target a dividend yield of between 3 and 5%. The last dividend was not a great dividend, unfortunately. I referred earlier to the fact that we are a technology-focused company, and we commissioned new technologies earlier this year, which we had to interrupt for a variety of reasons. We suspended the operation of the circuit, and we had to make a few engineering and management protocol modifications to that particular circuit before starting off with test work again in September. The impact on the share price was quite significant, but it does seem as though market confidence is returning into the share. We saw an increase of 21% in the stock on Monday, and that trend wasn't interrupted through to the end of the week. So we're hoping that it will continue. It is admittedly off a very low base, and that low base is as a consequence of poor operational and financial performance through to about March of this year. But it does seem as though we've turned the corner on the operating and financial results for the last quarter, ending June of 2014, were significantly better. So we are confident that we're on the right course. We will continue to look at new technologies to improve our extraction efficiency, because that's how we ensure that we can take full advantage of the entire resource under our control. So I suppose in a nutshell, the investment opportunity or the investment story is that we pay shareholders to hold our stock through our dividends, and we provide full exposure to gold price, and hence, depending on where you believe the gold price is going to go, and provided that you do a little bit of fundamental analysis on the stock, you might actually take advantage of the movement that our share offers relative to the gold price. I suppose to put it differently, because our risk is more of a manufacturing or processing risk as opposed to a mining risk. We avoid the big safety issues. We avoid the large labor contingency because we are mostly a mechanized process, uninterrupted mechanized process. I suppose we offer resource volatility and upside on either side of the cycle, but operational risk that you would typically associate with manufacturing. And as I said earlier, we are very much committed to the dividend story, and we will continue to pay dividends as long as the operating and financial results allow that, even in a bad year like the one that we've had in the recent past. The first item on the agenda, when we look at what do we do with our cash balance, and we have a healthy cash balance with very little debt. Very first item on the agenda is what do we distribute to our shareholders and our stakeholders. So that's DRD Gold.
Thank you very much. Just to very quickly conclude, I don't think we have a question. We don't have a time for questions from the public, but for those that follow the market, South African market is up 5% year to date in dollar terms. Nairobi Stock Exchange is up almost 17% in dollar terms, and Mauritius so far is lagging down 3% in dollar terms, but the stories are showing great opportunities in all of these countries. So thank you again.
Doing business in Africa. You can't afford to be without Africa Investor.